confusing on how you are going to post a refinance for your property in QuickBooks Online? I'm Laurie from Hudson Valley Bookkeeping, and in this video, I'm going to show you my system on how to properly post the refinance. All right, let's get started. All right, so let's talk about when you do a refinance. Before we get into QuickBooks, here is the scenario, and I will put this as a link that you could download. So if you want to print it out and follow along, just to understand some key concepts. So, okay, so let's look at the loan scenario and understand a couple key concepts before you get into QuickBooks. I recommend doing that all the time. Print out your chart of accounts, come up with your plan, mark up your closing statements or make a photocopy, mark those up, and really understand what you are about to do before you actually go into a QuickBooks file and do it, because so many people are blindly just posting things and they really have no idea what they're doing. They're just adding transactions. So posting a refinance, there's a couple things that we should understand in the beginning. If you're refinancing, you should have a loan on your books already, right? Because a refinance means you're taking one loan and you're replacing it with another. So one of our parts will be paying off the existing loan. So the first question I would say, and I get on QuickBooks coaching calls with people, and they want me to post some new loans and they don't even have the old one. So that's going to be a problem. I'm not going to get into that now, but just be cognizant that if you're posting a refinance, you should have that loan posted and reconciled so that the payoff, when we post the payoff of loan A, it is completely wiped out. And sometimes you might have to make an adjusting entry, like for the certain amount of interest that they gave as a payoff amount, and you wouldn't necessarily have a statement right then. But understand that that is one of the first steps you would need to make sure with your books before you start putting the new loan on, or just understand that you might need to make some adjustments. Okay. The other thing, I would create most of the accounts in your QuickBooks file before you start to post your closing. So you want to post your accounts in your QuickBooks before you start so that you're not trying to decide and figure out the type of account and so forth on the fly. It's much better to create any chart of accounts that you need to create before you, again, go and try and post. So I'm going to go over these codes with you. I'm also going to preface that I made this video previously and I'm just fixing it. I read about a new way of amortizing loan costs, and I checked with every CPA I know, and no one does it this new way, this 2015 gap code. So I am redoing this video. So if you notice any quirks in the video, that's why. I'm not going to redo the whole video, but I'm changing this where we're going to amortize the loan costs to other asset, how I've done it for 20 years. I was reading in some real estate accounting reference books, and they were talking about the new gap way. But according to 5 CPAs, unless you're some enormous company that gets audited and files gap financials, no one does it. So we're going to continue to amortize our loan costs in the asset section of the balance sheet. So if you ever hear about that 2015 new ruling, according to 5 different real estate CPAs that I know personally, none of them do that in their practices. So on the street, this is on the street accounting. Okay. So just if you notice any differences in the video, that's why. Okay. So we have to pay off our existing loan, right? So we're saying that's at Chase. So that's going to be one thing we're going to do. Then we are going to put a new loan on the books, right? Okay. We're going to have fees for our new loans. And that's a big piece of these posting closings. The closing statements will have all kinds of charges and credits. So you kind of need to plan on what you're going to go with that. Now, it's not going to be anything like a purchase closing. A purchase closing has taxes and insurance. It can have all kinds of different fees depending on if you're selling and you're paying the broker fees, or if you're purchasing it and you're having to pay the seller real estate taxes. So that's a very complicated closing to post. This is less complicated in the sense that normally, you're not paying for a survey, you're not paying for all of these, you're not paying for, you might pay for a little bit, but nothing like in a purchase, right? So in this case, we have loan origination fees, lender fee, appraisal, that's normal, an environmental fees, and then some processing fees. So all of this right here, these fees right here, I think it was about $14,000. That is going to be amortized. It doesn't go into your, 14,000. So you're going to get a new mortgage, right, of 650,000, but you're also going to pay 14,000 in fees. A lot of times that is lumped into your loan, but that cost cannot be expensed in 1 year. The amortized fees of 14,000 would be what we call spread or amortized over the life of the loan. So you don't get to take the expense of getting the new loan all at once. You only get to take it for the life unless you refinance again, and whatever balance is left, you will then add up. You will then be able to take the balance. So let's say you did 5 years. I'm just going to make it easy. Let's say we took, let's just do it right. So if we had 14,000 divided by 15 years, that would be how much we take each year. So I don't want to skip ahead too much, but that's how much you would be allowed to take. And that's where we're going to come into this amortization principle and accumulated amortization, and understanding how much you have left to expense over a life of a loan. And then the only time you get to take the rest, let's say we only did 1 year, right? And then we refinanced again, which no one would do, but I don't know, in like 3 to 5 years you might, because a lot of you are crack addicts and you're constantly refinancing and purchasing. But let's say we only had 1 year and then we refinanced again. We would then expense the balance, this 13,000. We would expense that in our next tax year. It would all be wiped out, because then you would have a new loan with new fees. So just understanding that before we get into posting that will be important. So, okay, now we'll go and get into the QuickBooks. All right. I'm also going to show you my technique with the exchange account. I do not like journal entries. I see it day in, day out. You can force it. It could go wrong. And so I'm going to teach you how to create a closing exchange account. We'll make one. So it's kind of hard to grasp at first, but it's pretty cool. So let's talk about that. Okay, so again, download this if you want, because I'm not going to jump between screens the whole time, and you can follow along. Okay, let's look at our balance sheet before we do anything. And now I first originally made this video on the 27th of December, so I'm going to change it to that. So we're all on the same page. Okay, so we are paying off an old loan. So we're going to go down here, and it has nothing to do with our purchase. The property stays the same in the asset section. It just has to do with the new loan. So what I did before as well is I went in on this mortgage, and we were talking about this one right here, the 123 Main Street, because often if you have multiple properties in a QuickBooks, you will often also have multiple loans with the same bank, because they decided they believe in you, and now you get all your loans from them. You all know who I'm talking about. Okay, so you could have multiple loans. A couple ways to differentiate them, because it does get confusing, and I don't really, other than the last 4 digits of a loan number, it's usually not helpful. But one way to do it also is to put the amount of your payment each month. That can help, because I've had some books where there were so many loans happening and they were all at the same bank, and it was very hard to pick which one to post to. But if you actually put the payment amount, that's helpful. So in this case, though, we are refinancing and paying off this Chase mortgage. So one thing to do, so you always know if your QuickBooks is right, is I put in here refinance 12/27. So if we're looking at this in January of 2026 and you still have a balance, then you know something's wrong. So now let's just look really quick. I'm not going to keep pulling this up. It's going to be too hard. But we're going to pay this off. We're going to post our origination fees and any of our loan fees to another asset. And we're going to post what's happening here. Okay. So let's go for it. What I told you in the beginning that I use an exchange account, and I'll explain why. A lot of times you will pay money, let's say part of your loan fees, before they will even do the loan, right? So you might have to pay a $5,000 to the bank 2 months before the closing. So it's hard if all of these transactions are happening in and outside of closing. Sometimes you pay your fees outside of the closing and so forth. Like you might be writing a check for this $14,000 in fees, right? So if that's happening again, it's very hard for a newbie to post these things, especially when they're not all happening in one day. So that's why I use the exchange. The other thing is you don't get this 30-line journal entry and you can't figure out, you're out and you're not sure why. So if you post small amounts of your journals, it's also easier. So one of my coaching clients recently, it takes a minute to wrap your head around it. I taught her, I posted a couple closings with her, and then she was able to do it on her own. And she really does like this system. So it's just much, I find that people make a lot of errors and plug when they're doing a big journal versus I can always find that if a journal's not right if I use a closing exchange. Okay, so now we have to write this loan off, right? So here's one of the easiest ways to do that. You can kind of like work out like what do I need to have happen and use that closing exchange as part of the piece. So it's just basically a bucket where the ins and outs and all the charges go into, and then it's only correct if it nets to zero after you have posted your entire paperwork. Okay, so I'm going to go over here to chart of accounts, and I know that that chase needs to be paid off. So I'm going to say, okay, I'm going to pay off the chase. That's one of the steps. That's the most logical piece is a refi means that one's wiped out, right? So I'm going to say here, I'm going to go view register. Okay. So we did on 12/27/25, refinanced to Provident. And I teach this as a way to do a lot of journal entries because it is just more logical for especially people that don't understand debits and credits. So look, our balance is 300 and we need to take it to zero. So the only way would be to decrease. If I put in the increase, we would have a balance of 600. And now I'm going to say closing. And see, I do it for all my things, Provident. So that's the name of the new mortgage. I'm going to click save. Okay. So now in my Provident account, I now have 300,000. But watch, it's going to go to zero. It's going to go up. It's going to go down. So look, now I got this 300, right? It's an asset. It's negative. So now we go to the next step. So it's good to keep like a pen or something. Now we have a new mortgage loan of 650,000. So that's the next thing we would do. Okay, I figured out how to highlight again. Okay, so we paid off the existing loan, so I'm going to mark that green. What's our next thing? We're going to go put our new mortgage on our books. So I already set up all of my items so that I talked about that before. You should get everything set up ahead of time before you jump in your QuickBooks. 12/27/25. And just put in something because if you have, you're going to forget. I swear you will. So this is 650,000. And again, we're going to go to that Provident closing exchange. Okay, so then let's go over here. We posted that. Okay, now I'm going to post each one of these separate in my loan costs, because you will ask yourself later, or you could be going for another loan and you want to know how much they charged on a prior loan, and are the fees in line with what you normally pay. So you want to have those it just takes one more minute to put them in that way. So I'm going to do it like this. I'll just copy it. And then I'm going to go back, financing costs Provident, right? And I want to increase these. So I'll just say journal entry. And I just put it in the memo. And the loan origination fee was $6,500. Oops, and I want to increase these. So I want this to be a positive balance on my balance sheet. And then again, I'm going to put this to my closing exchange. Okay, and I'm going to do it again. And this is my lender appraisal. And that is 3,000. Okay, so I did 2 of them. This is a good way to keep track. Okay. That is 2,000. Oops. So just keep marking things off as I post them. And I use the tab button a lot. They now have it so you can use the tab button, and it's so much easier. It's like desktop. Okay, so that's my 14,000. Okay, so I posted everything, except now it says net cash out to borrower, right? So that's usually why you all do a refi, is because you want to get money out of your property. I've never seen it just because someone wanted to lower their payment. Okay, so where's this going to go, right? This is on the debit side, but that is going to be deposited into the bank account normally. So this 336,000 then needs to be deposited into your bank account. So I believe it's a Chase checking. Chase checking. So we're going to add a deposit. And we said that the net cash is 324. Okay. So now let's see if we now it could get a lot more complicated, but this is why then if things were happening inside or outside of your loan, you could post these pieces off the statement. And a lot of times I'll see like the 5,000 was paid 2 months earlier, but it's toward these fees. So you could put it against the loan fees, back in November of 25, and that's going to sit there in that exchange account, because it's kind of like a prepaid money. Now, if the loan never happened, we're then going to just expense it as lost money, right? But those have to sit on the balance sheet. You can't expense those loan fees like that. Okay, so let's go look. You want to really get comfortable looking at your balance sheet. And I'm going to do it as of 12/27, because that is when we put this loan happened. Let's see what's going on. Okay, all we care about is, look, I have $12,000 left. So I have a problem. This is correct. I have 14,000 in my financing costs at Provident, right? Now let's go check the loan for Chase. My loan went to zero, so that's correct. And my new loan balance is 650,000. So now we've got to figure out what went wrong. This happens all the time. This is why we do that exchange account, because it can't be forced. Okay, so this is exactly why the exchange is so important. I had this printed out, but I did this video a month ago, and I don't know what I changed, but I typed in on this sheet, it says 324,000, but the amount we're doing today is 336. So if you're watching and you saw me post the wrong amount, you see how that exchange proved that it was wrong. We would also later found it was wrong when we did the Chase Bank rec, but that is why the exchange is so important. So I'm going to go back here, and it just shows that even I can make a mistake, and this is one way to make sure you're doing it correctly. So 336, and now let's check our balance sheet. And look, now our exchange went to zero. Okay. So then here you have your financing costs, right? Now you will expense that. You would, if you're financing something in the last couple days of a year, you're not going to take, I don't believe you would take any amortization for that, because you only had like 5 days that you had that. So let's just say that you have to divide that between 15 years, which is this 933.33. So I'm just going to show you what that means. So you would make a journal entry for 12/31/26. Okay, so I'm going to say amortization of loan costs. We had how much? 933.33. And then we're going to go to accumulated of Provident loan. Okay. So now it's a year later. Now, usually you can drag these, so this could be the top, but now you know what, this is what's so nice about this is you know where you're at, right? So that you know that you have this much more money you're going to be able to expense over the next 14 years because you did year one. And so you have this that you're going to continue to expense unless you refinance or sell, then you would get to take all of that. Same thing like you see here, you have depreciation that helps you understand your basis. And then you go down. Now we didn't post any payments to your loan, so right now it's still that. But those are the two main pieces of posting a loan, is understanding that those expenses cannot be taken in just year one. And how I think that closing exchange is just so much easier for anyone to post because it catches your error, because all of it has to even out in the end. I have posted some different refis and loan closings with clients that I work with quite a bit as they purchase properties. I usually post their purchases. And with one gentleman, we were out like $85. And after about 20 minutes, I said to him, I really don't know why you're out $85, but I don't think this closing statement is correct. I think they shorted you $85. And, he said, well, for $85, I'm not going to have you continue to stress about this. So we just kind of posted it to miscellaneous and moved on, because $85 in, the larger scheme of things was not a lot of money. So about 3 weeks later, I got an email from him, and he said, you wouldn't believe it, but they actually sent me a check back for the $85. So that is where that closing exchange does not allow you to plug it until you have really determined that you have literally posted debits and credits of that purchase and it doesn't add up. And that can happen. I don't know how many closings you've been to, but it seems like chaos and a lot of people running last minute numbers all at once. So I wasn't that shocked about the $85 either. So I hope you enjoyed this video. Please post any comments. Let me know what kind of videos you'd like me to make for you. Again, I'm Laurie from Hudson Valley Bookkeeping. We specialize in commercial real estate bookkeeping, and I give personalized QuickBooks coaching. All right, have a great day.